learners. Welcome to our session today. I am instructor CPA Ringo Frederick. In our class today, we are looking at financial management, and the concept that I want us to dissect today is a concept to do with weighted marginal cost of capital, commonly known as WMCC. WMCC. So, first of all, as we normally tend to do, it will be very important that we do understand the concept behind it, so that in the event that we're handling a question, things will always be very easy on our end. So, understanding WMCC, by now I know we are very familiar with weighted average cost of capital. By now I know we are very familiar with the concept of weighted average cost of capital, WCC, right? Because to explain this, we'll be giving a distinction with WACC. So, looking at WMCC, my good students, anytime you're talking of WMCC, what must always come at the back of your mind is that take yourself as an investor, right? In this case, there was an existing capital structure that you're having in your company, correct? You've identified a new opportunity that has come, whereby in this case, you'll wish to invest in that opportunity. Basically, you are talking of a very new project which was not in existing. So, in this case, to finance this project, you'll have to look at the sources that you're going to finance this project. And most likely is whatever that you're having in your capital structure is what you'll be using at least to finance this new project. And remember, at this point, because of the sources of finance, they'll always be attached with what? With a cost. They'll always be attached with a cost. At this point, you can recall the concept that we did in relation to the components cost of capital. So simply, anytime you're talking of WMCC, you should understand that we are looking at the combined, these are basically the combined, talk about a combined cost of raising additional new funds, to finance new projects. That is the key, that you should understand that basically we are looking at the combined cost of raising new additional funds to finance what? New projects. Get a clear distinction with WACC, which we covered earlier on. WACC, it is just the combined cost of raising funds to finance what? Existing projects. This is existing projects. WACC is the combined cost of raising funds to finance existing projects. Whereas WMCC, marginal, combined cost of raising additional new funds to finance new projects. That's one thing that you should also be able, or rather you must always be able to have at the back of your mind. Okay? Now, after you've passed that step, let us proceed to the second step. By now, we should be having clues on what we will be required to identify. So, step number one in computing WMCC, my good students, what you must be very good to make sure that at least you should increase your chances of passing that paper is for you to be able to identify what? Term them, we're looking at steps, right, in computing WMCC. The first thing that you should be able to do is to identify cost of new project. Cost of new project, or projects that you want to finance. That will be very important. Step number two, my good students, what you should do for you also to increase your chances of passing this paper clearly is to do what? Is to determine the proportion that each source of capital that you're having in an existing structure will contribute to these new funds that you want to raise. So in this case, you're saying you should determine the proportion of fund that each source in the existing capital structure, will contribute to the new project. That is to say, I'll be having my existing capital structure, which in this case, basically, these are the sources of funds. So you need to determine the proportion that each source will contribute to fund this new project that you're having. And of course, without saying, you must also be able to do what? To compute. You should also be able to compute the components cost of capital. You should be able to compute the components cost of capital of raising new funds. Therefore, that is the other step whereby it should also be very key that you should be able to compute the component cost of capital of raising these new funds. Okay? Lastly, of course, you need to do what? Number 4, determine the weight. Determine the weight of what? Of the new additional funds to be raised. Determine the weight of new additional funds to be raised on each source. Then multiply by what? The components cost. Then multiply by the components cost and get the summation to give you what? To give you the WMCC. Weighted marginal cost of capital. That is very important for us to note. And once you've mastered these tests, my good students, you'll find that things will always be very, very easy on our end. To cement this concept, I want us to consider this question that Mwalimu is going to share with us here, and we should be able to see how these questions are always being tested. That's very important. That is very important for us, okay? So the question that Mwalimu is going to share with us here, it was attested in financial management, a CASNEB exam paper, which was tested in December 2021, specifically question number 3. And Mwalimu has shared the question with us in our screens, which I believe we are able to see it. And by the way, you can as well get this paper just below this video. You'll be able to get this paper. So at this point, looking at it clearly, if we are to work it out, these are what you're told, that Mavazi Limited is a firm that operates in the textile industry. Over the last 5 years, the firm has experienced a stiff competition that has significantly reduced its turnover. In order to remain profitable, the firm's management is considering diversifying its operations. Where we are told that this activity will require additional financing of 50 million. So exactly we are able to pinpoint the new funds that we need to raise, which was how much? Which is 50 million. The firm's existing capital structure is given as follows, where I'm having the existing capital structure is what I'm given here. Correct? Continuation of that, these are what you're told. Additional information that the firm's existing capital structure is considered to be optimal. The firm expects to raise 5 million from internal sources in order to finance this diversification activity. And I believe by now, whenever you're talking of internal sources, we clearly know that we are talking about what? Retained earnings. And for retained earnings, recall, we say that at this point, you can't issue it to the public because it is what? It is internal. Number 3, we are told that most recent dividends paid by the company was 2.5. Sorry, before that, we are told that, however, new ordinary shares will be issued at 32 per share and incur a flotation cost of 2 shillings per share. So I'm going to issue ordinary shares which will incur flotation cost. We'll have to consider that very appropriately. The most recent dividends paid by the company was 2.5 per share, which is expected to grow at a constant rate of 5% per annum in perpetuity. Very important to note. And 4, new 12% redeemable debentures. And mark my word, mark this statement that we are talking of what? Redeemable. The new 12% redeemable debentures will be issued at 110 each. A flotation cost of 15 per unit will be incurred. The par value of each unit is 100, and the debentures will have a maturity period of 10 years. So ideally, we are talking of a maturity period of these debentures. So in other words, you're talking of what? Redeemable. At that point, what must click at the back of your mind clearly is the concept of what? YTM, yield to maturity. We are told that new 14% irredeemable preference shares will be issued at 90% per share. The par value of each irredeemable preference share is 100. The corporation tax rate applicable is 30%. That is what the examiner is giving us. Here we are told required, number 1, that we are required to compute the cost of ordinary share capital, the cost of retained profits, after tax cost of new 12% debentures capital, cost of new preference share capital, and finally, weighted marginal cost of capital. Look at the marks that the examiner is giving you. The examiner is giving you here how many marks? 14 marks clearly. Actually, this examiner wants you to pass these exams on a first attempt. As I've said that this paper, you can just get it on the description below this video. You are going to download this paper so that whenever we are working it out, you are also following it appropriately. So I'm mentioning that these are what you are going to do. Allow me to start working it out. I'm going to squeeze this question also so that it can also allow us to working it out as we are following. So having that case, the first step that we need to do, of course, is to identify the cost of new project. We need to identify the cost of our new project. After we have identified the cost of the new project, my good students, we need to do what? We need to determine the proportion of talk about fund that each source in the existing capital structure will contribute to the new project. Then of course we compute the components cost of capital, then we determine the weight. So this is what Mwalimu is going to do. I'll always advise that at this point we know what we need to do, what? Identify the cost of the new project. And the good thing with WMCC, so long as you master the concept, it will never change. It will always be like that all through. In every question that you'll be doing, you'll find that once you are able to identify the procedure right, things will always be very, very simple, and you just be following the steps. You just be following the steps. So mentioning that case, we need to identify the cost of our new project. And the cost of our new project is how much? Cost of new project. Cost of new project. We are talking of, we are planning to raise how much? In that case, I can clearly see we're given what? 50 million, right? So the cost of new project that you're planning to raise is 50 million. Our good examiner here, he has given us our figures into thousands. Cost of raising new funds, or rather cost of the new project is 50 million. 50 million, and I believe that is what you are given. That's our first step, okay? Then that is, of course, you're told yeah, the cost of financing that new project is 50 million. The other key that you need to do is to determine how much will each source that we are having in our existing capital structure will contribute towards these funds that we need to raise. So that will be simple. Come and copy and paste. You see where we are having our sources of capital. So basically our sources is what you are given there directly. Like we are given, I'm having ordinary share capital. Allow me to use all share capital, or rather ordinary share capital. Ordinary share capital, which you are given a figure for much 60. Right? The other source, we're having what? Reserves. We're having reserves. Reserves, my good students, I was given a figure for much? 10. So I'm having 10. Then we're having what? 11% debentures here. So I'm having 11% debentures. So basically, allow me just to use debentures. Debentures, you are given a figure of how much? You're given a figure of 20. So I'm having 20. Look at another case, I'm having what? Preference share. So for preference shares, I'm given a figure of how much? I'm given a figure of 10. So that ideally, the total of all this, you're given a figure of 100,000. That is what our good examiner has given us here. This is our existing capital structure. This is our existing capital structure. So what we want to do is to determine what will be the proportion that each source will give to these new funds that we need to raise. That will be easy. Determining the proportion, I just divide here by 100,000. I divide by 100,000, right? I divide by 100,000. And of course, divide by 100,000. What do we need to raise? We need to raise 50. That is our plan. Times 50, times 50, times 50, right? So that as at the end of the day, I'll be able to know each source we will be required to raise how much. So the first case here, I'm having 60 million divided by 100, of course, times 50, which should give us a figure of 30. The other one, I'm having 10 of 100, of course, times 50, which should give us 5,000. Believing that you're following together. 20 of 100 times 50, this should give us 10,000. Then this other one should give us what? 5,000, right? So that as at the end of the day, I'll know that each source, this is what will be contributing, given the fact that you're told that the capital structure was optimal. Meaning that in this case, you'll find that I won't be consider any other source other than what you're having. So that as at the end of the day, I'll be having what? I'll be having the 50 that we need to raise. If at all you sum up these 5, or rather these sources, it should give us 50. So that is what we are required to do. And actually, you'll find that so long as you've mastered this concept, my good students, so long as you master this, you'll find that WMCC will be very, very easy. WMCC will be very, very easy. Now, after that, considering that you had an optimal capital structure, let us work out our components cost of capital. Talk about our components cost of capital. That will be very easy, my good students. Why are we saying it is easy? Right now, whatever that will guide us are the sources that you're having here. You see these sources? These are what you're going to have. So, number one, I'm talking of ordinary share capital. So that should come at the back of our mind is what? Cost of equity. So you're talking of cost of equity. And you know very well that for us to determine our cost of equity, in this case, we're looking at ordinary shares, right? We should be having the following. That is, of course, we should always consider our current dividends that you're paying into 1 plus G. We are going to divide all this by the market value of our shares. we less any flotation cost. Suppose I'm issuing these shares, I'll be having some cost which you can incur, which you're terming them as flotation. I can issue these shares at a discount. So if we issue them at a discount, they will reduce the value of market value for shares. Then I should not forget to add what? Our growth rate. So basically, this is exactly what we are supposed to do. Other times, you can use the one. Whatever that I'm having here, you see this aspect that you're having here as a numerator. Basically, this is what? This is the same as talking of the one. This is the same as talking of what? The one. This component here is the same as talking of D1. So once we have that case, come to our question. Let us see if we are having these variables, we pick them in our formula. As simple as that. As simple as that. So in this case, we should be having the following. I'm talking of DO. I want you guys to go to which note? That is note number 2. The farmer expects to raise 5 million from internal sources in order to finance this diversification activity. And the good thing, see what we've done. Reserves, internal sources, you clearly see that if it was optimum, this is the retained earnings. And retained earnings, recall we say that we will never do what? We can't issue retained earnings because these are internal. So at this point, given that it is optimal, the maximum that I can raise out of our retained earnings is what? 5 million. And that's the same thing that the examiner is telling us here. That's the same thing that the examiner is telling us here, that the farm expects to raise 5 million from internal sources in order to finance the diversification activity. Okay? However, new ordinary shares will be issued at 32 per share. Look at that case. You're going to issue new ordinary shares at 2 shillings per share and incur a flotation cost of 2 shillings per share. So I'm having a flotation cost. Then below that, you're told that the most recent dividends paid by the company was 2.5 per share. That is our DO, the most recent dividends paid per share, which is expected to grow at a constant rate of 5%. Clearly here, we have everything now. I'm having our DO, which in this case I was given in note 3, which is 2.5. So that's what you're going to take. I'm having 2.5, our DO. Into 1 plus growth rate. Clearly, my good students, you can see our good examiner has given us a growth rate of how much? A growth rate of 5% to perpetuity. So 0.05. Okay? Then in this case, you're going to divide all this by what? We're going to divide all this by the market value, which you can check my market value. I was given 32. So I'll be having 32 minus flotation cost, which was how much? 2 shillings per share. So I need to deduct that too. We are just following our formula. Plus our growth rate, which in this case, our growth rate will be how much? Our growth rate is 0.05%. My good students, you are done with that case. You're done with the cost of equity in that case. Let us see what we'll be having. I'm having 2.5 times 1.05. We are going to divide, that one is 30 plus 0.05, which in this case I'm getting 13.75%. Kindly you can confirm. I'm getting 13.75%. 13.75%. That is cost of equity ordinary shares, right? Talk about cost of equity because that is our first source that you're done with. Remember what you are looking at. We are following exactly what you're having. So the first case, you're done with the cost of equity. Then proceed to the next item here. Just a moment here. The next item that we need to consider is cost of equity retained earnings. Cost of equity retained earnings. Cost of equity retained earnings. Again, you'll find that that will be very simple. Just following our procedure the way it is. Following our procedure the way it is. I'll be having my formula here. KE to be equal to. So we're talking of KE. But this time around, we are looking at what? Retained earnings, retained earnings, retained earnings. Recall for retained earnings, we are not issuing it out. So you can't have flotation cost and you can't have discount. And that's why our formula will be like this. I'll be talking of our current dividends into 1 plus G. We have our market value of our shares plus G. So like in our case here, I'll just be having the same thing, 2.5, 1 plus 0.05. So this time round, I won't deduct flotation cost. I'll just be having the 32. We add our growth rate, 0.05. So basically at that point, how much will you be having? I should be talking of 2.5 times 1.05. We divide by 32 plus 0.05. In this case, I should be having, of course, I'm getting 13.20%. So my cost of retained earnings here, I'll be having 13.20%. And that is what we're having there, my good students, which you can clearly see. Then the next element will be what? So we are done with this ordinary shares cost. We are done with retained earnings cost. So we proceed to debentures. And debentures, my good students, we are told that we are having what? Redeemable. Because if you can check in our note, which I believe my question is still there and is still visible, I want you guys to check in note number 5. Not 5 or 4, not 4. Not 4, check it out. New 12% redeemable debentures will be issued at 110 shillings each. New 12% redeemable debentures will be issued at 110 shillings each. A flotation cost of 15 per unit will be incurred. A flotation cost of 15 shillings per unit will be incurred. The par value of each unit is 110, or rather the par value is 100, and the debentures will have a maturity period of what? 10 years. Debentures will have a maturity period of 10 years. So once you have that case, my good students, what should come at the back of our mind? What should come at the back of our mind? At this point, what should come at the back of your mind clearly is for you to recall the concept of YTM, yield to maturity. Yield to maturity. So determining our KD, where in this case you are talking of redeemable, I should be having YTM times the component of tax 1 minus T. This is what should always come at the back of your mind. YTM times 1 minus T. I know the big question will be, Mwalimu, what is this YTM? Do you still remember how to work out our yield to maturity? That's the next big question that you should ask yourself. Recall that for you to determine yield to maturity, which you are terming it as YTM, you must always be having this in mind, that we are talking of our interest first thing. Talk about our interest. We are talking, of course, of our interest. That's the first thing that should come at the back of your mind, right? So we are talking over, of course, my interest. We are talking over our interest. Let me have it here. Interest. We're going to have one of the number of period. N basically is number of period. I should be talking of my aspect of what we normally refer to it as par value, or rather the face value of our debentures or debt minus our market value of debentures or debt. Okay? All of this you are going to divide by a half. All of this, we are going to divide this one by a half into my face value minus what? Our market value. Our face value minus our market value. That is YTM. I know I've reminded you guys something that you had already forgotten maybe, right? That's why you are here. And at times you'll say, mwalimu wafanye kazi yake. Right? Mwalimu wafanye nini? Mwalimu wafanye kazi yake. So once we have that case, that will be very simple for us. And what we should be having in mind, that remember, we are issuing these debentures with a flotation cost of what? The figure that I was given there was how much? 15 shillings. So in this case, first of all, in mind, let me have what? My market value. My market value will be the how much we are given, if you can check that note. That is what you are given there. Yeah, we are given that at this point I'll be issuing as these debentures. New 12% redeemable debentures will be issued at 110 each. A flotation cost of 15 units will be incurred. The par value of each unit is 100. So basically we are talking of the market value, yes, was 110, but there's a flotation cost that we are incurring of 15. So that is to say my market value will be how much? 110 minus 15, which will give us what? 95, which will give us 95, which will give us 95. So this is the market value that we are going to use. So copy and paste. Interest. Interest will always be determined on per value. That's the secret that Mwalimu is giving us, that interest will always be determined on per value. So on that case, we proceed and determine our per value here. We are going to have my YTM. We should be having interest, which was at 12%. Per value, which I was given 100. Plus 1 over number of period. In this case, it's expected to last for 10 years. Yield to maturity, or rather the aspect of maturity period was 10 years into what? Face value is the same as per value, which our per value was 100. We have determined our market value after deducting flotation cost to be 95. All of this we are going to divide by a half into face value, which is 100. We add, that one we add, not plus, that one we add. Aspect of how much we add, of course we add 95. We add 95. Remember this one, we are doing what we are adding. We are adding that one, we are adding that one. Sorry for that, we are adding that one. So that as at the end of the day, this will give us our YTM. That will give us our YTM. So my YTM here, bracket, that is of course 12%, 0.12 times 100, close bracket, times, that is of course plus, I open my bracket here, or 1 over 10, 1 over 10 into 1 over 10, actually that is 1 over 10 times 100 minus 95, that should give us 5, right? Times 5. So I'm having a figure of 12.5. Answer, I divide by, I open my bracket, a half times 195, right? If we sum it up. So basically that should give me a figure of, that is of course, just a moment here, I've messed it up. So we start again. We are talking of open bracket, 0.12 times 100, a close bracket. In this case, we are going to add 1 over 10. We add, of course, 1 over 10 times 5. I'm going to divide 12.5 by a half times 195 times 195, so that as at the end of the day we should be talking of 0.1 to 8.2. Then recall what you need to add here is what? This is basically my YTM. So my YTM, I can take it to be 0.1282, basically 12.82%. I should multiply, recall this, I should multiply by the component of tax. Remember, interest tax shield. This is what we are talking of, 1 minus t, which would give us 0.7, which would give us 0.7. So therefore my KD here, which ideally we've taken YTM times 1 minus t, that should give us what percentage there? So times 0.7, which clearly here I'm getting times 100, I'm getting a figure of 8.97% to be our KD. I'm having 8.97, 8.97. So you're having 8.97 there, 8.97%, 8.97%. That will be our KD. So recall the trick with this is upon you just to understand the aspect of what you are dealing with earlier on. YTM, concepts of YTM. Sorry, let me squeeze this question down. Yeah. So basically, once we have determined that, you'll find that things will be very easy on our end, because now we have determined our cost of equity, cost of retained earnings. Now we have also determined our cost of debt. The next thing, what will you be required to do is, of course, to determine your KP, cost of preference shares. KP, again, things will be very easy and simple, because what will be required to do here on our KP, allow me to squeeze it down there so that we can have it as you're working it out. So KP, I should always be having my preference dividends, okay? Preference dividends. We are going to divide all this by the market value of our preference shares minus any flotation minus any discount if you're having any. And preference dividends will always be determined on par value, will always be determined on a par value. So let us check out note number 5. New 14%. Talk about, in this case, you're told that new 14% irredeemable preference shares, new 14% irredeemable preference shares will be issued at 90 per share. The par value of each irredeemable preference share is what? 100. So my par value already, the good examiner here has given us to be 100. Now, how will you go about it? At this point, I should be having of course, my preference dividends, which is 14%. Sorry for that. 14% times, of course, my par value was 100, which was given there, 100, right? New 14% redeemable preference shares will be issued at 90 shillings. So I'm having 15%, or rather 14, par value of each redeemable preference share is 100. We divide by the market value, which in this case was how much? 90. Will be issued at 90 per share. So once you have that case, what will you be having, my good students? What will you be having? I'm seeing my producer is telling me if I've gotten a vaccine. I got that vaccine very, very long time ago, right? So in this case, we are talking of 14%. So we are talking of 14%. So I'm having 0.14 times 100. We divide by 90, which in that case, of course, should give us 15.56%. 15.56%. That is what Mwalimu is getting. You can confirm it on your end. The beauty part with marginal cost of capital is that once I have determined this, majority of the work we had already computed it at first. So without knowing, my good friends, you can find that we've handled number 1, number 2, number 3, and also number 4. So we are required to work out now WMCC. We are required to work out now WMCC. Again, you'll find that WMCC will be very simple. Why is Mwalimu saying it is simple? Now I can remove this question of mine so that we have all our space, right? I can remove this question of ours in our display so that you can have all our space. Okay, so that you can have all our space. The beauty part with us doing all these concepts, computing our WMCC things will be very, very easy. Why? Because I'll just be copying and pasting here. So this is what you're going to do. Hopefully this will fit. Hopefully this will fit clearly. I'm having our WMCC computation. Hope this space will fit, yeah. So I'm having our sources here. The sources that we had ordinary share capital. Ordinary share capital. I'm having reserves, which basically are retained earnings. We are having debentures here. We're having debentures here. And finally, we're having what? Preference shares. So allow me to use preference shares. And recall, we had already determined what each source will contribute to these new funds that we are planning to raise, whereby we had 30, we had 5,000, we had 10,000, and 5,000 respectively here. So what will be our weight here for each? So this should give us 50. So weight for each component, weight for each source. Like the first case, ordinary shares, I'll be having 30, I divide by 50. 30, I divide by 50, which would give us how much? Our weight. 30 divide by 50, that should give me a figure of 0.6. 5 divided by 50, that should give me a figure of 0.1. 10 divided by 50, that should give me a weight of 0.2. And this one 0.1. Of course, the weight should always add to 1. What about our cost of capitals? Cost of capital, we had already determined that. We start with KE. Cost of equity, ordinary shares, we had 13.75. Cost of equity, retained earnings, we had 13.20. Cost of debt, in this case, we have determined it to be 8.97. Whereas cost of preference shares, I'm having 15.56. What has remained? My goods, surely, according to the steps that Mwalimu had given us to multiply, right? So that for us to determine our WMCC, we should be having, the first instance I'm having 0.6 times 13.75, which will give us 8.25. The second one I'm having 13.20, we multiplied by 0.1, which will give us 1.32. I'm having 0.2 times 8.97, which will give us, that is of course 0.2 times 8.97, which will give me a figure of 1.79. Then finally, preference shares, 15.56 times 0.1, which will give me a figure of 1.56. So having that case, let us sum it up to give us our WMCC. We sum it up to give us our WMCC, which will find that it will be very easy. It will be very, very easy. So summing it up, I should be having 8.25 plus 1.32 plus 1.79 plus 1.56. Mwalimu is getting 12.92%. So this will be our WMCC. That will be our WMCC. Just imagine, as simple as that. So I know if you clearly followed the procedure that Mwalimu has given us from the word go, your problem with WMCC is over. If you follow the procedure that Mwalimu has given us from the word go, your problem with WMCC is over, right? The next class, I'll want us to handle the concept of WMCC, but where we are introducing a new source. Say, for example, in our case, assuming we didn't have preference shares, our existing capital structure was only of the three sources. But right now, maybe I am introducing a new source of capital. For example, here you're talking of preference shares. I want us to look at that concept in our next class. To that point, guys, I believe you've enjoyed the class and you've learned. So let us meet in our next session. Thank you so much, and you have a nice time.